After selling your business, many people think tax planning is over because now my income has potentially been cut in half, a fourth, it's significantly lower. But the reality is, tax planning is not only for today, but it's also in the future. In today's video, what I want to look at is one of the key areas to focus on when you are a business owner that is either approaching retirement or in retirement. Today's topic is going to be on required minimum distributions, which is where the government requires you to pull money out of your tax deferred accounts. My name is Luke Turner, co-founder of Moment Private Wealth. We help athletes and entrepreneurs get smarter with their money. Let's dive in. Today's topic is on required minimum distributions. And before we jump into different strategies to help us reduce those required minimum distributions, first, I want to outline what a required minimum distribution is and how do you actually calculate it? Because these are very important things to understand before we even consider any strategies. So, a required minimum distribution is where the government takes their pound of flesh. They have allowed you to defer taxes in these qualified accounts over numerous years. And at a certain age, they require you to start taking money out of those. So typically, the types of accounts that we are talking about when we're referencing RMDs or required minimum distributions are traditional IRAs and 401ks. Again, these accounts are ones that when you put money into them, you're going to get a tax benefit today. On your tax return, any money you put in there, you are going to get a tax deduction in that current year. But when you take those dollars out in the future, you're going to have to pay ordinary income taxes. And for many of the entrepreneurs and business owners that we work with at Moment, they typically are not utilizing their 401ks or IRAs to fund their lifestyle. But nonetheless, the government is going to require you to take money out at the age of 72. So when you're 72 years old, the government's going to say, we've allowed you to take a tax deduction when you put the money in. This money is grown tax deferred over potentially decades. Well, now we are requiring you to take some of that money out. And the way the government looks at that is they have a table called the Uniform Tax Table. And on this table, which you can see over here on the right-hand side, this table is going to outline a math equation that allows you to calculate how much you are required to take out at each age. So what the government says, let's just look at a real life example. They're going to look at all of your IRA balances on December 31st of the previous year. So let's assume that you're going to turn 72 in the year 2024. What this means is that we are going to look at your IRA balance as of 12/31/2023. We're going to take that number, let's assume it's $1 million, and we're going to divide it by the uniform tax table based on your age 72, which is 27.4. And then that's going to spit out how much money you are required to take out in the year 2024. Now, many business owners hate this rule because what ends up happening is it's very tough to plan around taxes when there's this lump sum that now has to come out of your IRA or your 401k. In many situations, this could be jumping into new tax brackets, costing you thousands of dollars in taxes. But luckily, we're going to look at two specific strategies that can help you reduce this with proactive tax planning. The first strategy we want to look at is what's called a QCD, or Qualified Charitable Distribution. So one thing the government does allow you to do is if you do not need your RMD for your lifestyle living expenses, you can donate it directly to charity. And this is what's called a QC, or Qualified Charitable Distribution. These QCDs, the biggest benefit is that these dollars never hit your tax return from an AGI perspective. AGI just stands for Adjusted Gross Income, and AGI is what is utilized to calculate many of the other income taxes that you may be facing. It could be your Medicare premiums, it could be your Social Security tax. And the great thing is that a QCD allows it to never hit that AGI. It's not just a tax deduction. So for example, if you wanted to give away your entire RMD, it is going to be as if you do not have to realize any of those taxes. It never hits your adjusted gross income, and you have to give it directly to charity. So that is a key with a QCD. You can't take the money out, put it in your bank account, and then donate it. You have to donate it directly from your IRA to that charity of your choice. But it's a great tool and a strategy that we've implemented many times for business owners. The second strategy is a Roth conversion strategy. And the great thing about a Roth conversion strategy is that this strategy is something you could be looking at implementing today, even if you're not 72 years old. So for many business owners, in their situation, most of the dollars they have invested are in what are called taxable brokerage accounts. This has come from either saving money or selling a business. And they realize that at a younger age, maybe 50 or 40, that they're probably never going to touch the dollars in their 401k or need to touch them. So what they end up doing is what are called Roth conversions. So the way that we think about this is we're moving money from an IRA to a Roth IRA. And just a short blurb on this, just as a reminder, IRAs are tax deferred, Roth IRAs are tax free. And the benefit of a Roth IRA is that there's no required minimum distribution for a Roth IRA. So what many business owners do is they take money in their IRA and they convert it to their Roth IRA. When they convert it to their Roth IRA, they're going to pay taxes in that year. So let's say you take $1 million, you move it from your IRA to your Roth IRA, you're going to realize $1 million of taxable income that year, and then that money is going to grow completely tax-free. So that's a second strategy to help minimize those RMDs, because the less money we have in your IRA or your 401k, the smaller your required minimum distribution is going to be. If you want to learn more about those Roth conversions, you can click on the link over here and you can see a full video that we've put together specifically on Roth conversions. So if you are facing required minimum distributions and you're not sure where to turn, please feel free to reach out in the link below at momentprivatewealth.com. Thank you.